Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Lots of interesting things to talk about this week with the stock markets and the commodity markets. And of course, any stock codes you'd like me to have a look at, get them ready. We'll go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's get into this week's first chart. And first up, we have the ASX 200. And well, the ASX 200, it's closing in on a new all-time high. But is this rally about to stall? I'll talk more about this in a moment. And then over in the US, last week we talked about maybe some cracks appearing in the NASDAQ. Are those cracks getting bigger, and what should you do now? I'm going to come back to that shortly. But before we get to that, let's start with this latest price action in the ASX 200. So this has been an important week for the local index. Prices broke below the moving averages last Friday. So you can see I've got the 50 and the 100-day moving averages. Prices broke lower on Friday, and in doing so, they fell below two recent lows. So one being the late January low and then the early February low. But importantly, when prices broke down, there wasn't follow-through selling, and prices have quickly rebounded within 24 hours. This is a strong buy the dip response, and it makes last Friday's sell-off. It was a bit of a scary sell-off during the day, I think, for a lot of people, but it makes that sell-off look like a short-lived panic, not the start of a trend change. As we discussed last week, the key now is for prices to become established above these moving averages, just like they've been doing since around mid-January. I think the fact that the latest dip below the averages, I think the fact that it couldn't be sustained, I think that's positive, that prices are now back above the averages. And I think another positive is that the snapback rally took the ASX 200 within a few points of its October all-time high. But is a sustained break of this all-time high likely in the near term? Well, I've got a couple of charts that I want to go through with you that I think help answer that question. So first up is the materials index. Let's just change over to this. This is the ASX 200 materials index. So this is where all the big mining stocks live. They live in this index here. So BHP, Rio, Fortescue, all the big miners are in this index. So this remains in a strong uptrend, and this has been a key support for the ASX 200 in recent months. Prices are above the moving averages, so you can see the 50 and the 100-day moving averages, and those moving averages continue to rise. So this is an overall bullish backdrop for one of the most important segments of the ASX. This is a trend I'd want to stay on, and I am staying on through my own holdings. But one thing to put in mind is that it has come a long way. It's come a long way since it first got above the moving averages back in July last year. And when a market goes a long way, it gets stretched above its moving averages. Don't be surprised when in those situations you get a pause and a consolidation. I think that's entirely possible where things are now. And I think if we were to get a consolidation in the materials, maybe a pullback towards the moving averages, in the scheme of the trend, it really wouldn't be a big deal at all. If something like that were to happen, it would be it would take away a near-term driver for the ASX 200. The other big sector to watch at this point in time, it's what's going on in the financials. So let's just go over to the ASX 200. This is the ASX 200 Financials Index. And we were looking at this last week. We talked about the improving technical structure, how prices had gone from below the moving averages to just moving above, and the moving averages had just gently started to turn higher. I wasn't expecting such a quick acceleration. I thought the financials might take some time to become re-established above the moving averages, before then potentially moving into a new upward phase. But some good results from CBA through the week really helped fire up this sector, and it's a big reason why the ASX 200 is will nearly hit a new all-time high this week. It's really been the banks have really been the driver, CBA in particular. So where to now? Where does this go now? Well, a market that quickly runs from below its moving averages to above, what often happens in that situation is that there's a pause and a consolidation. So we go from, and we saw the same thing in reverse here. We went from above to quickly below, and then there was a consolidation. I think the opposite could happen here. We've gone from low to high, crossing the moving averages, and now maybe we get that pause and the consolidation. I think that's a good possibility here. The moving averages are turning higher. You can see the moving averages are starting to turn higher, but they've been left behind by this week's strength, by the acceleration in the price action. So a pullback and a consolidation would give these averages just a chance to start to catch up. So I think there's a likely scenario where the two big drivers may temporarily pause, being materials and financials. So that would almost certainly cap the ASX 200 in the near term. And lastly, there's the ASX 200 equal weight, which I think we need to have a look at as well, because this is important. And don't overlook this. So what we've got a quick reversal from above the moving averages, quick decline, and that decline, well, it was only a 2-week decline, but it erased all the gains from December and January's rally. All those gains, erased within about 2 weeks. So sharp declines cause technical damage, and it often takes time to repair that damage. So we've gone from above the averages to below. We've had the rebound, a bit like I was just describing with the financials. This big pullback in the equal weight, it doesn't end the trend. It doesn't end the uptrend, which has really been in place since back in April last year. It doesn't end that trend, but with fewer stocks actively participating in the advance. And this is what the equal weight is telling us. It's telling us that fewer stocks are participating. So the ASX 200, CBA has been the big driver, but in the equal weight, CBA has 1/200th of an influence. So without that broader participation, with fewer stocks participating, I think it opens a prospect for more consolidation over at least the next few weeks. Coming back to the ASX 200, just to be clear on this, I want to stay long stocks, but I'm a little cautious on the near-term prospects. I think that potential for a pullback and a consolidation certainly does exist. I think now's a time to give winning positions room to move with the aim of seeing off any further consolidation. So that's what I'm doing in my portfolio. I've got lots of winning stocks. I'm not looking to rush out and sell them today. I'm looking to give them lots of room to move to hopefully see this off. But at the same time, be ready to sell what's no longer working. And then I also think be patient with buying for now. Let's see whether how this price action stabilizes and settles down. We're going to go over to the S&P 500 in the US market now. First of all, though, if you're getting some value, please click that like button and leave a short comment. What do you think? Do you think we're going to new highs in the near term, or is something else about to unfold? So let me know in the comments, and please click that like. It really helps me so much when you do that, because then YouTube shows other people, and that, like all the investment and time to make all this happen, it really helps when YouTube's showing other people and other people can watch. So please do that now whilst you think about it. Okay, S&P 500. Well, is Thursday's selling, is this weakness we saw on Thursday in the S&P 500 a concern? On its own, a 1.7% decline back to rising moving averages, which we still have, the 1500-day moving averages, they're still rising. On its own, a pullback to rising moving averages is not a particular worry. There have been several pullbacks to the moving averages since November. So you just look at the price action since November in this space here. And look, we've seen this several times, several moves back to moving averages. So nothing untoward necessarily there. So that's all been part of the S&P 500 moving sideways within a trading range, because basically been in a trading range for the last few months. So I don't think Thursday's decline adds anything new from that perspective. It's more sideways chop within a range. But it's what's happening elsewhere that I think we should focus our attention. So let's jump over to the NASDAQ. So this is the NASDAQ 100 index. Now, we spoke about the deteriorating structure in the NASDAQ last week. So at that point, the NASDAQ had just broken below its January and December lows, and it had two consecutive closes below the 100-day moving average. Hadn't done that since back down here in April last year. The structure has weakened further this week. And you can see that with, like, we had a brief rally and then selling pressure has re-emerged at the 50-day moving average. Prices have traded lower on Thursday. So that starts to shift investor behavior from buying dips to selling rallies. It's like we don't have a confirmed breakdown at this stage, but that's the sort of price action we're starting to see. We're starting to see rallies being sold. The NASDAQ also had its third close below the 100-day moving average. And the moving averages also appear to be in the early stages of just starting to roll over, particularly the 50-day. You can see it's got that downward slope to it. And one more thing, there's also a false break in late January. So see this break in January. We had, like, you could say we had resistance along previous highs, and we had prices coiling within a range. We had a brief breakout in late January, which quickly failed, and prices have moved back lower. So false breaks are always worth paying attention to, as they can be a warning that buying power may be weakening and lead to lower levels. A quick example, I can just show you this from February last year. We had a coiling pattern along the moving averages. Prices broke higher briefly, couldn't sustain it, fell, and then that led into something larger. Not to say that something larger is going to happen, but that's what we prepare for and are aware is a possibility when you get some of these signs like false breaks and selling rallies appearing. I'll show you another point of concern, and that is with the Magnificent Seven. So this is an ETF which tracks the Magnificent Seven, those big seven stocks. So Nvidia and Apple and Amazon and Microsoft, they're all tied up in this ETF. So look at last week's trading, because the Magnificent Seven is even weaker than the NASDAQ. So what I want to point out here, prices have been consolidating below the moving averages, and these averages are starting to turn lower, more so than we're seeing in the NASDAQ. You can see the hundreds also starting to lose some altitude at this point. And we've had that consolidation beneath the moving averages. So consolidation below declining averages, that's a vulnerable setup. And then on Thursday, look what happened on Thursday. Prices broke to a new low. So it's starting to develop a sequence of lower lows and lower highs. You can see the highs have been getting progressively lower, and so have the lows. And now we've got a new low. So we've got a bit of a sequence starting to develop. Again, it's that case of the rallies being sold. I don't think this is a bear market warning. So a bear market is, bear market can where prices fall 20% or more and can go on for some time. I don't think this is necessarily a bear market warning, but I think it highlights the prospect of a period of instability and lower levels, whether it be over a few weeks or a month or two. We don't know, but we can see that there is those cracks of vulnerability appearing in some of the price action. So why do I think it's not an evolving bear market? Well, we don't have bearish signs from other key sectors. So take the S&P 500 equal weight, for instance. So this is the S&P 500 on an equal weight basis. And what we have here, well, it's the same when you look at the Dow Jones. We've got a textbook uptrend. There's a long-running series of rising lows and rising highs, and the moving averages are trending higher. The 50 and 100-day moving averages continue to trend higher. And on Thursday, the equal weight hit its highest level ever, so an all-time high. It did reverse later in the day, and we could say that this is technically called a reversal day, but that doesn't necessarily mean a bear market. It means, well, maybe there's a pause in the trend and there's some weakness coming. But overall, this overall structure continues to be strong. And it's also worth pointing out that this is the like, you just contrast what you're seeing in the equal weight with what we see in the S&P 500, and the outperformance in the S&P 500 equal weight compared to the index. It's the greatest outperformance since 1992. So that's a sign of strong underlying participation in the S&P 500. In fact, this week I saw that 19.7% of S&P 500 stocks hit a one-year high. So that's the first time that many stocks have hit a one-year high in 6 months. And that's often a positive backdrop for stocks for the year ahead. But supportive underlying conditions, as I just mentioned, like participation and nearly 20% of stocks hitting one-year highs, supportive underlying conditions doesn't necessarily mean there won't be volatility along the way. And that's kind of that's what we're talking about at the moment with what we're seeing going on at the NASDAQ. Can there be a pullback within an overall bullish trend? Coming back briefly to the S&P 500, while this overall trend in stocks remains intact, I think what we're seeing in tech increases near-term risk. And I don't think we should simply brush off that weakness in tech by saying, oh, look, it's just sector rotation. I think there's enough evidence here for some near-term caution towards the US market generally. And I think that means, especially with new buying, I don't think there's a rush to do a whole lot of new buying, at least this week. For me, that means holding winning positions, giving them room to move, having a plan to sell stocks that aren't working, not letting losses get away from me. And as I say, being patient with new buying. Let's see how this structure plays out over the next week, maybe 2 weeks, and then reassess from there. Okay, we're going to move into the small caps next, US and local. Interesting things to take in there. Then into the commodities, lots of interesting things to talk about there with what's going on with commodities. And then, of course, your stocks. So any stock codes you're interested in, you want to have a look at the technicals, get them ready. We'll go through them in this next part of the show. But of course, that wraps up the free section. If you're not a Strategy Session member, there's a link below. Click that. Come on in. Doesn't cost you very much. And we're going to do a whole lot of interesting things, which I don't think you're going to find elsewhere. So think about doing that. All right, so let's go over to the Russell 2000 and talk about the US small caps.